So welcome to this video. In this video, we are going to discuss about basic investment appraisal methods. So this is a very important chapter. So we'll be like discussing about various investment appraisal methods such as NPV, IRR, ARR, payback, discounted payback. So we'll be like looking at what are the various pros and cons of each method. We'll also see like where these methods are applied and where these methods are not applied. We'll start from payback. It is the time it takes the cash inflows from a capital investment project to equal the cash outflows. So we can put it like this: the cash flow inflow and cash outflows should be equal. That is what payback is indicating. So assume that you have invested around 10,000 rupees in a project, and the inflow per annum from the project is 5,000. So what is the payback? Payback is simply 10,000 divided by 5,000. The answer comes to 2. So that is the payback. How it is measured? It is expressed in years. What is this 2? This is 2 years. If it takes 1 year to receive 5,000, next year we will receive 10,000. So 5 plus 5 is 10. So the cash inflow and outflow are equal. So cash inflow and outflow are equal. That is what payback indicates. So when is this ratio better? The lower is the better. So why do we use payback period? Payback period can be used as an initial screening to filter projects which have a lesser payback period. So assume that a company is evaluating which project to invest. So they have an option of 20 projects. See, for all 20 projects we can't do detailed analysis. So initially the company says, let's select all projects which are having a payback of less than 5 years. We'll select all those projects. So all these 20 projects are checked with payback, and now the company would come with only like 5 projects. So these 5 projects having a payback of 5 years. The other 15 projects might have a payback like 5.5 years, 6 years, 10 years, or 20 years. So those are like rejected. So this is the features of a payback. So we have given it in a kind of a overview. So here we are going to discuss about the features of payback. So is it simple to compute? Yes. Is it easy to understand? Yes. Does it consider the whole cash flow of a project? The answer is no. Considers the cash flow? Yes. Considers the time value of money? Again, no. Maximizes wealth? No. Focuses on risk? Yes. Because how does it focus on risk? It tends to put more value on liquid projects, projects that give money very quickly to the company. So it tends to favor liquid projects. Can we do any additional calculations with this payback? The answer is no. Does the answer come in percentage? No, the answer comes in years. So that's about the payback period. We also have some more pros and cons of the method. So there's a good thing about this method. The fact that it tends to bias favor over short-term projects means that it tends to minimize both financial and business risk. So we can put it like this: assume that you don't consider payback and you select projects. So the projects that you have selected which are really good are like 10-year project, 20-year project, 25-year project. If you are going to invest in these kinds of long projects, okay, what happens is you won't get much money in the upfront years. It is over a period of years that you're going to get the money. So that is a problem, that you might end up in liquidity problems. If you use payback and then select, you might select projects which are 2 years payback, 3-year payback, or a 6-year payback. So now what happens is you select projects which are short term oriented and liquid in nature. So this method tends to favor projects which are liquid in nature. So a company will always have a good liquidity. Drawbacks of this method: Payback is unable to distinguish between projects with the same payback. If two projects are going to have 2 years of payback, another one also has 2 years payback, then there's a problem that which one has to be selected. The choice of any cutoff period by the organization is arbitrary. So the company says select projects which are having a payback period of less than 5 years. In that case, we choose all the projects which are less than 5 years. But who fixed the 5 years? That 5 years is arbitrary in nature. Some companies can fix 5 years, some can fix 7, some can fix 10. So there is no like scientific method to arrive at the cutoff year. So what happens is it is just a subjective number. Next one, it may lead to excessive investment in short-term projects. So the example which we saw, like 2 year project we select, 3 year project we select, 6 year project we select. See, these are like very short-term projects. Assume that 2 years are over. Again, you have to run and select a project. Assume 3 year is over. You again have to run and select a project. So there is always a constant search for new projects. So that is a problem here. So if you are going to invest in projects like 10 years or 15 years or 20 years, once you have selected it, you are going to keep on going to earn an income for the next year 10 years. You're not going to search any project. So that is the drawback of this method. It takes account of the risk of the timing of cash flow, but not the variability of those cash flow. So it says that in the year 1 we will receive 5,000, in the year we will 2 we will receive 5,000, like that it tells. So it tells you the timing of cash flow, but doesn't tell will we what is the surety that we will receive 5,000, okay, in the first year. What is the surety that we will receive 5,000 in the second year? So it does not tell the variability. We can put it like this: any cash flow which we predict in the for the first year, for the next 1 year, there is high certainty we will get it. But the longer the duration, assume in the second year we are expecting 5,000, there's a higher variability that we might not receive that cash flow. So again, this method does not take this variability into account. So these are the pros and cons of the payback period. So we'll move on to the discount payback method. Discounted payback method is a very simple thing. It just discounts the cash flows. So it is the same thing as payback, except for the cash inflows are discounted. So that is the only difference here. Again, this method expresses, again this method is also expressed in years. The answer is also like lower the better. This is also used as the initial screening for the projects. So the only difference is the discounted cash flow that is being used. So we'll see the feature. The only feature that is different when compared to the payback for discounted payback is that it considers the time value of money. So that is the only one difference between the methods.